So happy to see so many people interested in talking about and learning about investing. This is part of our financial literacy series that we have at SBH in partnership with Mesila. We talked about understanding our financial style a couple months ago. We also had a conversation about budgeting, especially when we're newlyweds and starting out. And so this is the third session that we're having around financial literacy. Now getting into investing, at whatever stage we are in our lives. We're going to talk about the why, the when, and the how of investing. Why should we invest? When to start investing? How to invest? So I'm Sarita. I am going to moderate this session. I am a mother with yeshiva bills, with college bills, with a mortgage, with auto loans. I rent a deal house in the summer. I have credit cards. I have a job that has, steady paycheck. I have a 401k. So, I have bills, some money. I want to learn about investing. I hope you want to learn about investing like I do. And I'm going to be very interested in talking with Aaron and Brooke tonight about how we can invest and, what's the right way to spend our well-earned money, the right places, and how to invest that money. So I'll turn it over to Aaron to introduce yourself, and then Brooke, you'll take it also.
Thanks so much, Sarita. My name is Aaron Katzman. I am a licensed financial professional in the United States and actually in Israel. I'm actually coming to you live from the holy city of Jerusalem. And it's a pleasure to be with you. I'm a financial advisor. I work with an advisory group based in Miami called Portfolio Resources Group. And I work with clients to really understand what their goals are, what their needs are, and then we invest the money accordingly. I've written a book on retirement investing, which was published by McGraw-Hill. I write a weekly column on investments in the Jerusalem Post. I have a YouTube channel. I'm quite active on social media, and it's my pleasure to join you this evening to see what we can accomplish in getting you on the right track for investing.
And also, Aaron has a channel, and I've stalked a lot of his talks about investing. They're very helpful. So if you like what you hear, definitely look him up and listen to a couple of his sessions. Brooke.
Hi, I'm a registered dietitian. My name's Brooke Lowenstein, but I'm a regular person who's very enthusiastic about investing. So just the other night, my husband joked, I think somebody kidnapped my wife and replaced her with Warren Buffett. After all, when we met back in 2007, the only thing that I thought of was an investment was a Louis Vuitton handbag. Don't get me wrong, I still love shopping at Bloomingdale's, but being their top tier customer is no longer one of my top priorities. I'm happy to say I'm more excited about when a stock's on sale than when a pair of shoes is on sale. I accepted this invitation to speak on this panel because I'm not some kind of mogul, but I know there are other people who struggle to begin saving and planning and investing. They view their situation as standing at the foot of a very tall mountain. In truth, I hope to inspire everyone to see that financial independence is something that's very attainable and within everyone's reach. And as we learned from Rabbi Akiva, that small drops over time can even penetrate a rock, so too can small incremental steps and investments over time can help build a nest egg regardless of where your starting point is. So I hope I can inspire everyone. Okay,
thanks,
thank you, Sarita.
So let's start off with the whys. Why not keep all my money in cash, either in the bank or under the mattress? For Aaron.
Okay, so there are two major reasons why we want to invest and why we don't want to keep our money under the mattress. Number one is something we're actually all feeling right now. It's in the news all the time, right? There's supply chain issues. When you go to the supermarket, to fill up your wagon costs a lot more money than it did a year ago. And that's called, what do we call it? We call that inflation, right? So if you leave your money in the bank. I think the last reading was around 7% or whatever. That means, over the course of the year, the value of your money is depreciating by, let's say, 7%, 6%, whatever it is. The first reason we want to invest is just to keep the purchasing power of your money. What's that mean? So that when I go to the supermarket, the same amount of money buys the same amount of goods. The way to do that is by investing, right? If I leave the money in the bank not earning anything, I'm losing out to inflation. So now, reason number one we want to invest is to at least keep up with inflation. Reason number two we want to invest is to have a secure financial future, to help make weddings for our children, retirement, whatever your sort of longer term goals are. I want to show you something to show you sort of the power of why we should invest, that we should invest younger, at a younger age, but still the point is you want to keep investing, you want to be consistent. Do you all see the screen that I'm currently sharing the compound interest calculator? Great. I'm going to put the link also in the chat box so you guys can, play around with it and see it a little bit later. But let's just say, for example, I'm able to put together $10,000, right? Maybe I got married, I got some gifts, I got a bonus at work, whatever it is. I start with $10,000, and I'm also able to, we're going to get into this later, but I'm able to save, however, $5,000 a year. And I want to let it go for 30 years, right? I'm investing for the long term. And I'm going to be, let's say, take a much lower than standard market rate interest rate. I'm going to get 7% annually. I'm going to end up with, in 30 years, virtually $600,000. Okay, I'm not doing a lot, right? I'm not really, I'm not changing my lifestyle so much. I'm not living in the basement of my parents' garage and saving on rent. I'm living my life, but I'm putting away a little bit constantly. And look at the power of investing. And that's the second reason, the more important reason, to answer your question, Sarita, why I don't want to put money under the mattress is because look what it can do if I get it to work for me. And, time is your friend in this business. And again, you don't have to be Warren Buffett. You can just do things. We'll get into it later, how to do it. But, it's not all that complicated. And you can, and at the end of the day, you can have a real big nest egg.
That's very helpful. And I have so many questions just based on what you explained to us. And I know we'll get into it a little bit later. And let's just continue with the why in terms of the goal setting. Brooke, what are your thoughts on having a goal in mind, like Aaron said, like thinking about a wedding or thinking about some other focus area as to why you may want to invest versus a generic reason?
So I think having goals helps you sacrifice and actually direct that money there. Like one of my goals, for example, is retirement. So instead of spending money, I'll push money aside. And then I'll see those retirement accounts grow. Another one is kids' college savings. I'll put money aside and see that grow. Because when those life times, when I get to them, I want to have money for that and not be able to pay for it. And then that helps you take away from, just spending money on day-to-day things and push money aside and see that account grow. And I always make sure to label things like this is the savings, this is the retirement accounts.
And we can talk about kind of setting up those different accounts. And like you said, Brooke, we can either have one account, multiple accounts, we can earmark them. We talked about in a past session on the budgeting, how some of us have, our bills account, and some of us have also the fun account, and you start kind of playing mind games with yourself of what money is available to you and what money you have to use and what money is more discretionary. So, we'll start talking about what kind of accounts we'll set up and get into that a little bit. I was just, again, staying on the topic of just how to get started. What are those common barriers? Yes, you put up the 10,000 to 5,000, but sometimes in our minds, we we still are hesitant to lock that money up, or find that money where we think we actually are very tight in a particular time. So what other barriers do we have to getting started on investing, and how can we take away those barriers?
So I want to circle back to something you were talking about earlier, and then we'll get into that. The goals. I run what's called a goals-based practice, right? Where it's not just to make as much money as humanly possible. Very few people have that as a goal. Most people have goals: retirement, marrying off children, travel, whatever it is. And what's important to point out is that at different stages of life, your goals and your needs change. And what they are when they're 25 are not what it's going to be at 35, and not at 45, and not when you hit retirement. So that's always moving. And you always have to sort of reassess your goals and make sure that when you're investing, that your investments match whatever your goals and needs are at that particular moment. I just wanted to point that out. Now, in terms of barriers, I think that the biggest barrier is psychological. That either we feel that we don't have enough money, that investing is for rich people, right? That's sort of a fallacy that's perpetrated in the media, and it's sort of out there, right? That you have to be rich in order to invest. And there's nothing further from the truth. You can invest for as little as probably $100 or $200, even less now, today. So you really, number one, there's no financial barrier to start. Number two, it's like anything else where you start, you have to start, right? And sometimes we're scared if it's dieting, if it's going to the gym, whatever it is, right? In life, you got to push yourself and do it, right? Open the door and get out there and do it. It's the same thing with investing. So, we put it off. We can always take that $500, like Brooke said, and go to Bloomingdale's, right? We can always spend the money somewhere. We can always use the money. The point is being disciplined. And when you set up your budget, right, instead of having, more discretionary spending and buying whatever new gadget, if one of the line items, and one of those line items is high up in your list, is what we say, pay yourself first, which is saving, which is investing, then you've sort of taken care of that. You've earmarked, right? Like we've spoken about earmarking, you earmarked money in your budget towards investing. I think that's the most effective way to do it. And oftentimes people don't do that. And at the end of the month, I don't have any money left. I spent it because I decided to go out to Limo Ray or whatever it is, right? And there went my last $250. But if you budgeted at the beginning, and at the beginning, I'm making my mortgage payment, and right after my mortgage payment, I pay my utilities, and right after that, I pay myself first. I send money into my investment account. You're going to be way ahead of the game, and that's the best way to get going.
And Brooke, we're going into the when, which is perfect segue. There have been numerous articles written about the fact that women generally start investing later than men. And possibly because what Aaron is talking about is psychological, possibly other reasons. Can you say some words around, being a female and getting involved in investing, and what held you back and what propelled you forward?
Okay, so I think what propelled me forward is I always do the pay myself first model. And I set aside a certain percentage, and I have specific goals that I want to achieve. So when I get paid, I pay myself first, and I direct those to my savings. And I just stick with it, like over years, pushing that money towards there. So it's a line item, and it's not negotiable that I'm not going to do it. So it's more of the just do it mentality. And I tried never to skip. But I do definitely see that people, by not setting it as part of their line item weekly or bi-weekly, however they get paid mentality, think that what's investing $1,000 going to do? But like Aaron said, you do it over time consistently.
Great. And one more question on the when, especially for, I mentioned my mortgages and my auto loans and my credit card bills and my other bills and all the debt that I have and that I'm sure most of us have. What is the balance between maintaining that debt and not paying it down versus using that cash they may have to put it into investments? and let that investment grow while that debt still stays on? And is there different kind of debt that I should think about, keeping on, and other debts that I should say, no, focus on paying that down and don't focus on investing the cash? Any balance there on debt versus investing?
So I would say on that other than a mortgage, we really should stay out of debt. There is probably nothing really called good debt, but if there is good debt, it's a mortgage. Assuming that that's all we're talking about, then I would say, you should save. You should try and save between 10 and 15% of your. If you're great and you're gung ho, you can boost it up to 20. But if you're in that 10 to 15, 20% level based on your salary of saving that amount of money, anything above and beyond that can go to pay down your mortgage. If you have all kinds of consumer debt and what have you, then I would probably tell you to get rid of that debt first, because that's very expensive, and get rid of all that debt before you start investing. But since we're focusing here on investing, let's just go with the mortgage only, and say 10 to 15% of your salary save, and anything above and beyond that sort of in parallel, right? So you're building your assets on the one hand, and you're building even more and more equity. You're getting rid of your mortgage in an accelerated fashion. I think that's the most effective way to ultimately build wealth.
And then when you're out of the other debt, you can use that extra money to then invest more. Then you free up.
Right. So get rid of the bad debt.
Yes.
And then use that money that you were paying down the debt with, and now that's available money potentially to now invest in addition. So that's great. Okay, so let's get into the how. How much money do I need to start investing? 10,000, 100,000, $10. How much money? I
think the smaller number, right? You don't need to start with $250,000. Like I said before, it's not a game. This is not a business for that you have to be rich. That's not the barrier to entry. You can start with $50, $100, and set up, a monthly direct deposit into a fund, or however you want to do it. There are multiple ways out there to do it, but in terms of the amounts, it's negligible. It's a couple cups of coffee, right? You can skip 2 coffees at Starbucks a week, take that money and start investing it.
Okay, so now I have my $100, right? And I want to open an account. What kind of account do I open? Do I open a Robinhood account, an E-Trade account? Do I call JP Morgan and open an investment account? Do I have a managed account, self-directed account? Like, there's all these options out there. What do I do with that $100 to just start?
Right. So if we're not talking about any kind of employer based program, a 401k or anything like that, and it's like it's taxable money that you want to put away. For $100, you're not going to call JP Morgan, you're not going to call me, you're not going to call financial advisors, right? They have minimums, but there are plenty of places that you can turn. Like you mentioned, E-Trade. I would probably stay away from Robinhood at the beginning, but unless you're incredibly disciplined. But E-Trade, Charles Schwab, all these online brokers, it's incredibly cheap. I mean, it's basically, for all intents and purposes, you're investing for free. You can invest in certain products of theirs. It doesn't cost anything, and there are no annual fees associated with it. It's a great way to start, and you can just sort of feed it at the beginning and get going. And once you get to a certain mass, a certain amount of money, then you think about either going to a financial planner, sort of for a one-off, where you pay you'll pay an hourly fee, and you can start discussing your goals and your needs and getting your portfolio attuned to those. Or you go to a financial advisor and a money manager and you turn the money over to them. But that's sort of at a later stage or the beginning stage, but when you have more money.
Yeah, in fact, we have an account with my kids where they allow us to purchase fractions of stock. So let's say Apple is trading at 1,000. I have no idea what Apple's at today, and I don't have $1,000. I can actually buy 10% of an Apple stock So now I've only put in $100. And I'm still a shareholder now of a piece of an Apple stock. So these days, the stocks are skyrocketing, and it seems a bit prohibitive to want to get in on some of these stocks when they used to be kind of under $100 for every stock. Now they're multiples of $100. And I think that kind of is a psychological barrier to some of us. Like, I'm not just going to buy 10 shares because that sounds like a low number. But I don't think we should be thinking about how many shares we're buying of something. We should be thinking about how many dollars we're putting in, right?
Exactly.
And so on the topic of stocks, like, should we focus on stocks? Do we focus on bonds? Do we buy into funds? You know, is that all available for us? Is that something that only the fancy people get, like the bonds? Or, you know, how does that work? Should we just stay on stocks? What's available to us?
So what I would say to that is, again, it's based on your goals and needs, but there are plenty of online tools where you can actually go and put in your parameters, how you feel about risk, how much time you're able to invest. I know that if you go to iShares.com, for example, they have like a little calculator, let's say, where you put in certain data, and then they sort of even spit out a model portfolio for you. So you don't really have to know what you're doing. You don't have to know how to buy an individual bond or what have you. What I would recommend, at least at the beginning, is for individuals probably to stay away from individual stocks and concentrate more on very, very broad-based, what are called ETFs, exchange traded funds, which sort of mimic the market. That's what I would recommend at the beginning for anybody getting started. It's a good way to sort of, the slow and steady approach is a lot better than trying to swing for the fences and hit a grand slam. Most of the time people try that and they strike out, right? So if you want to grow wealth over the long term, I would recommend for most people sticking to like exchange traded funds or index mutual funds. Keep it simple and it's effective. It's the most effective way to do it.
And I mean, if this year tells us anything, right, just putting money into the S&P 500 had so many good returns. Mm-hmm. It was easier and more successful than I think most of the stocks that were out there. So it's I don't think kind of a backup plan to invest in ETFs and in funds, but rather it is a sound investment for a lot of us and has great returns a lot of times, you know, not always, but sometimes. And then, you know, how do we find those ETFs? Is there a place that we should look them up to get to know what's, you know, what they're made up of? Are they focused on a particular industry sector? You know, just to know what we're buying into before we go.
So I would say that there are plenty of websites. If you're opening an account with Charles Schwab or E-Trade, they're going to have all that information for you on the website. If you want to go on the internet, they're, you know, like I said, iShares.com, or you can go to ETF.com. There are all these different places which will sort of they'll tell you which is the proper ETF for you. You really don't have to do, you know, it's like using Waze to drive. You really don't have to know the streets anymore. You just listen to a little voice and they tell you what to do. It's the same kind of concept for investing. It's really fortunately or unfortunately, it's been sort of dumbed down, but it's great because you can let your money work for you and you don't really have to do anything. It's on a silver platter for you.
Brooke, in terms of, okay, now we picked a couple of funds or maybe a couple of stocks, we have a portfolio. How often do you check the portfolio? And how often do you call your father when the market is up or down?
Well, I check it daily, and multiple times a day. And I try not to call my father. I have a few buddies that we talk about it. And it's exciting when it's up, but I'm trying not to let it annoy me when it's down. I look at it like, okay, it's down, things are on sale, let's buy another share. okay, got a good deal. And then when it recovers and it goes back up, like, okay, when it was down and, everything was down, look, I got good deals and now it's going back up. So because I practice a dollar cost averaging model, just, buying regularly, like, God willing,
Yeah,
weekly.
can you explain what dollar cost averaging is?
Okay, so dollar cost averaging, you're not really trying to time the market. You designate an amount of money that you're going to purchase, like weekly. And if the market's down, you're buying, you're spending, let's just say I'm going to purchase like $200 a week. So this week I'll buy 200. If it's down, next week I'm buying 200. If it's up, and then over time, they show that historically that method, you end up with more gains than if you're trying to time the market. Yeah.
Right. So yeah, let's talk about timing the market, especially with the year that we just had, with the major ups and down swings. Do we try to time the market? Do we try to buy when the stocks are falling? Or do we wait and see? Do we sell and run away when the stocks are falling? Like, what kind of reaction do we generally want to have with these major highs and lows that we've had, especially this year?
So I think that's again, it's gonna be a function of your goals and needs and where you're holding in life. Rule number one is, if losing money is a problem for you because you're either in retirement, you don't have that much, and you can't take the volatility, then you have no business to be as aggressively invested as maybe you are, right? You have to understand when you invest in the stock market that you can lose money, you can lose a lot of money. That happens, right? At the beginning, just go back 2 years, 23 months, right? When COVID hit, within 5 weeks, the market lost 35% of its value in 5 weeks. Okay, if that kind of thing really, really freaks you out, and you don't have enough money to fund your retirement, you shouldn't be fully invested in the stock market anyway. So that's rule number one. I would say rule number two is, if you have spare money available and things are dropping, yeah, like Brooke said, you should, we all like a sale, right? We all love a sale. If we can get something for 25% off, that's great, right? So for sure, if you have spare money, you should buy it. But I think anybody who's got a long-term vision, a long-term outlook, shouldn't get caught up in the ups and downs, the small ups and downs of the market, because ultimately it's a dot in history. Nobody remembers, people who invest for the long term don't remember when the internet bubble burst in 2000, and they don't remember the financial crisis of 2008 and 2009, and they don't remember COVID, because we're way past that already in terms of the markets, right? So when you're in it, you have to, it's like a roller coaster, you have to have a strong stomach. But if you're focused on the long term, like Brooke said at the beginning, right? She's children's education and retirement, right? These long-term goals, as long as you're focused on those long-term goals, the sort of day-to-day volatility isn't so relevant. And I would suggest not to get caught up in it at all, unless of course you've got some extra cash and things are dropping, and then take advantage of the situation.
Like one thing that I like to do, I like to always have an emergency fund to last me past a certain amount of months. I tend to be very conservative. I like to have like 8 months to a year. And then my investments are things like that I really don't need for 5 years from now. So that, with the vicissitudes of the market, whether it's up, whether it's down, it's not going to affect me, because this isn't money for today. But as I get closer to, say, my daughter going into college or retirement, then I'm going to start to take that money out when it's at a good, level, and go into something safer like a bond.
That makes sense. Also, we spoke about, the cash that we have on hand and opening an account and taking that cash and continuing to invest. Let's just touch briefly on employer-based investing. For some of us that are in companies, can you speak, Aaron, to 401ks and pensions, and that as a form of investing in addition to the other stock accounts that we just talked about?
Right. So that would be, first and foremost, if you're getting those benefits, take them. Okay. For sure, take them. And that counts, right? That counts as your 10 to 15% of savings. So if you've got the 401k or any other kind of retirement plan from work, you're pretty much going to be hitting that number anyway. You're not going to have to save tremendous amounts in addition to that. If you can, again, fantastic. But you want to fully fund all of your retirement plans. If you've got IRAs, if you've got Roths, if you're getting a matching from your company, in whatever form, you want to take that and you want to get as much of it as you can and start investing. These are, for the most part, tax deferred vehicles, which is fantastic, right? You pay when you take the money out. And at that point, you're usually taxed. Again, this is for an accountant more, but in general, you're taxed as income when you take it out. So once you retire and you start taking money out of your retirement plans, your income level has dropped anyway because you're no longer working. So it's very, very favorable tax-wise then. And all those years that you're working and putting money away, it's growing tax-free. That's a huge, huge benefit. Can't stress enough how much people should take advantage of that. It's a huge gift that you're being given, and not to take it is sort of financial foolishness. You should run to sign up to the company 401k or start your IRAs or whatever, because it's over 30 years compounded without having to pay a penny of tax. You're going to be way, way ahead of the game.
I think, and I've learned this lesson, if you switch jobs, don't forget about your pension and 401k at your previous employer, right? I forgot that I had one account. It's fine. I found it. And I was like, wow, okay, there's a windfall. But what I learned is create a retirement account. And if you had a couple of different jobs, consolidate them to see it all in one place, to have, 5 or 10 different accounts, depending on how many jobs you may have had over the years. It's just too much to keep track of. And you may forget an account like I did for a little while.
You know what I really like to use? There's this free software called mint.com. And you can put in all your different accounts, like your retirement accounts, all your different bank accounts, property, bonds, different things like that. And it has it all on one screen. So it keeps it very clean and organized.
Yeah, that's a great one. Just sticking on the topic of taxes, I know this is not a tax session, but can you just speak briefly on short-term and long-term investing and the tax implications that we should keep in mind of, day trading versus holding long-term and what those ramifications are?
So it's really not, it's above my pay grade, as they say. I'm not a licensed CPA, but just in general, they're more favorable tax rates for positions which are held longer than 12 months. Short term, anything under 12 months is taxed at a higher rate. Keep that in mind. It's also important if you're going to be in taxable accounts, not in retirement accounts, right? In taxable accounts, and this is where sometimes people, when they do it themselves, miss out, as opposed to using an advisor. You should try to be efficient tax-wise. What do I mean by that? This past year, 2021, was a great example of that, where you probably in your portfolio had a lot of winners, potentially, a lot of stocks that did very well or have done well over the last couple of years, but you might have some losers also. You might have bought Zoom, right? You might have bought Zoom stock back in February when it was all the fad, only to watch it lose 60% of its value in the preceding 10 months or whatever, right? So you can actually take advantage of that loss, and it's called tax loss selling or tax loss harvesting. And you can offset gains and losses. I don't want to get into the minutia of it because it's even late for you, in New York at this point. And I'll probably put myself to sleep getting involved in these very, very fascinating issues of taxation. But just know that it's out there and you can save yourself over time. Again, we're talking about years and years If you're efficient tax-wise, you can save yourselves tens and tens of thousands, if not more, dollars over sort of the lifetime of your investing life. So it's very important.
Okay, so one last question, and then guys, if you have any questions, feel free to post them on the chat, or we'll give you the opportunity to unmute and ask the questions live. But one more question: crypto. Should I buy Bitcoin or any other cryptocurrency? Everybody's doing it. Everybody seems to be making money. Oh, we should talk about that when everybody's saying that they're making money. But you know, is that something that everybody has to do, or you know, some people can choose to do crypto and some people are not going to?
So what I would say is that in any portfolio, you can take 5 to 10% of it and put it into very, very aggressive types of investments. Crypto certainly would qualify for that. Rule number one in investing is FOMO, right? Fear of missing out. Just because everybody's doing it doesn't mean that you have to do it. Generally, if everybody's doing it and a lot of people have already made a lot of money in it, you might be late to the game. That's something that's very, very important with crypto, especially now. There have been frauds. It's not such a simple thing, even though you turn on the news and you heard that Bitcoin went up to 60,000 and whatever, and but it's dropping now, whatever. I personally would probably recommend people to stay away from it. But if they want to play around with a very, very, very small percentage of their portfolio and take a flyer, so you didn't hear it from me, but I guess it's okay.
Okay, and the same topic, NFTs. That's all the rage also. What do we have to say about NFTs?
I mean, it's the same thing. I wrote a column about this a couple of weeks ago. We had a parent-teacher conference about 2 weeks ago, I think, and it turned out I parked illegally. And for the first time in my life, over the loudspeaker, they said, they gave out the license plate number. My wife goes, "Hey, that's your car." I don't know, it's not my car. And anyway, they said it again. I ran down, and it was not our fault, but whatever it was. And then I met an old friend that I hadn't seen in probably 22 years. And she was telling me that her teenage sons are making lots and lots of money in NFTs. And her hope is that they lose it all, because they actually have had no concept of working hard, of doing anything. And they're playing around with this ridiculous, they buy a picture and then they make thousands of dollars at the end of the day. And she wasn't so happy with it. It's hard to imagine that these things are going to be sustainable, right?
And we won't get too much deeper into NFTs, but for those of us on the call that don't know what it is, it stands for a non-fungible token. It's a thing that you own that represents some other thing. That's basically how you describe it.
Based on your definition, it sounds like a really bad place for people to put their money.
Okay, we got the message there. So there's another question. What do we think about I-bonds? What do we think about I-bonds?
I'll weigh in on this. I just learned about I-bonds a few weeks ago. I was super excited. I felt like it was my birthday because I've been looking for something like this. It's backed by the United States Treasury, and it's a bond where your principal's maintained, and it's tied to inflation. So right now they're getting like 7.12%, and that rate is locked in until April. And then they're going to change the rate depending on what the inflation rate is. So it's very safe. You don't lose your principal, and interest compounds. So I think it's great.
Okay. I think there was a question for clarification on the 401k, but the tax-free component and then the tax component. So, Aaron, would you mind clarifying what part is tax-free, tax deferred, or tax-free?
Right. So a Roth IRA, you pay a Roth IRA, you fund it on money that you already pay tax on. So that sort of runs forever. And even when you take it out, you're not going to be paying any taxes. As opposed to a traditional IRA where it's deferred, the tax is deferred until you start taking your distributions later on. And then you pay, and then you're paying tax on it as income. It's taxed as income. That's the difference between the two types of programs.
Okay, and I'm just scrolling through the rest of the questions. It looks like we had another question on the managed versus self-directed investing. If we can recap that piece, like what is a managed account? What's a self-directed account?
So a self-directed account is when you do it, right? The client, the person who, the investor, I should say, has money and they make all the decisions, right? They do it themselves, sort of self-directed or do-it-yourself investing, as opposed to a managed account where you turn the money over to a third party and they, based on your criteria that you set forth and your risk profile, and again, your goals and your needs and your time frame and what have you, they create a portfolio for you and they manage it for you. So it's two different things. They cost more money. Managed portfolios cost more money, but usually you're getting a higher quality. You're getting institutional money managers for the most part to manage your money. These are people who are managing pension funds and they're managing billions and billions and billions of dollars, and they have their risk management techniques and what have you. The thought process is that they're able to do a better job than Joe investor who does it themselves on Schwab. Whether they do it or not, that's another question. And just to touch on something you said earlier about women delaying investing, but now they're becoming more of a force investing. There's been all kinds of research actually that women make for better investors than men. It's fascinating for all kinds of reasons. They're not as aggressive. They don't think that they can outsmart the market. They try to follow the rules of the basic rules of investing. And there's been all kinds of data that they actually significantly year over year outperform men. So that's just an interesting caveat to throw into the discussion that we had earlier.
I am not surprised. Do we have any questions that anybody wants to ask live on the Zoom? Anybody want to unmute and ask?
Yes. What about day tradings?
So, statistically, most people who try day trading are not very successful. We only hear, when you hear about the person who hit it big, that's because you hear about the person who hit it big. You don't hear about, as usually happens in investing, you don't hear about the people who pick the wrong investments and who lose money. Most people who day trade are not successful. It's just very hard to constantly be right. It just doesn't work, right? Again, I would say day trading is different than investing. I would say, if you're planning to fund your retirement in 30 years from now or 20 years from now, you should invest for the long term. Day trading and buying and selling is going to be a hard way for you to get there. Aside from the fact you're going to rack up a boatload of taxes, you're going to pay huge amounts of taxes and what have you. Maybe that's secondary. It's not a particularly successful way to grow wealth over the long term.
Any other questions? Okay.
What's the average percentage what you can make from long-term investment?
I think that's a very difficult question to answer, right?
Yeah, I mean, and your portfolio will be different than my portfolio because you might have, different needs than I have, right? But let's just say that over time, the market, and we'll just define the market as the S&P 500, and that might not be a good definition because there's 100 different ways you could define that. Over time has averaged between 10 and 11% annually. So that doesn't mean that you're going to make 10% every year, but that means that, over a 10-year span, if you look back and you figure out what your return was, that the average annual return was in the ballpark of 10, 11%. And these things tend to revert back to their averages. So, if you're defining the market by the S&P 500 and you put all your money into the S&P 500, which might not be also advisable, that's what you're looking at, for a return. But as Sarita said, that's sort of a loaded question without a definable answer.
One more question. Is there a way to know which stocks are better than the other ones?
Well, sorry.
Oh,
Wait, go ahead.
I'm asking if there's a, like if you know which, let's say Apple stock, right? It's supposed to be like a very good investment, correct?
Well, it all depends, right? So none of us have the magic 8-ball that tells us what's going to happen with Apple a year from now, right? We can only make the decisions based on the inputs that we have. So I don't think any of us are going to be comfortable saying, which stock make the most sense to buy here, because none of us can predict the future. But we have, like Aaron and Brooke mentioned, those websites that give us some background information. It gives you the financials of the company. It tells you their earnings. It tells you their investments. And I think each of us in the self-directed accounts have to make those decisions for ourselves or rely on those financial advisors when it comes to a managed account. But I don't think if any of us on the call know that answer, then we wouldn't be on the call.
Bingo.
Just one thing in response to his question, like if you invest in Apple, you can listen to their quarterly conference calls to see how they're doing, how much cash they have, how much they're earning, to see how that's doing. And also somebody on the chat asked a question about backdoor Roth IRA. The government's stopping that for 2022. So that option's no longer going to be available.
I'm sorry, I don't think that's true yet. I don't think it passed.
Oh, it
That
didn't pass?
backdoor. It didn't pass. It's actually they're debating it now. I don't think it passed completely yet.
Hopefully it doesn't pass.
I hope so. I hope not. Yeah.
Yeah.
Okay. So I think we're going to wrap up. I think it's way past Aaron's bedtime in Jerusalem. Thank you for joining us. We hope that this was informative. Happy to take any questions after. And I think Sherry, Rita, we're going to send out an email after just to the participants. And we hope that you'll join us on our next installment of our financial literacy series. We'd love to get your feedback. Thank you for joining.